How's it going? We're going to do the debt schedule and we'll solve the debt schedule. And then we'll also find out the application of the debt schedule. How does it go into the three statement model? So let's pull up that file. All right. First thing I always like to look at is let's go to the grade system here. The first thing I want to show you is that the balance sheet does not balance. So it has to do with the balance sheet, definitely. Um, you scroll down it, it's going to affect the income statement. Income statement is not complete. It's going to affect the cash flow statement. Specifically, with financing and cash summary, it's going to affect. It's going to affect current liabilities, fixed assets. That's it. So let's go back to the model. What we need, here's the debt schedule above it. I'm going to plug the application goes into the balance sheet. It goes into the cash flow statement and it goes into the income statement. If I go below the debt schedule, what do I need to plug into the debt schedule? Well, I have to know the equity schedule. You don't have to know how to solve it, but you have to have the equity schedule solved, or you plug it in, but you have to solve it to get the debt schedule correct. Okay, the first thing we're going to do, you want to know what we're doing here is there's two steps. We're going to find out how much cash do we have, number one, and then number two, do we have to use a revolver? So I have to figure out what is the free cash flow of our funds. So once I find that out, I'll know exactly if we lose money that year, do we have enough money to pay off the revolver from the previous account? So according to the assumptions we made, if we have a revolver, we want to instantly pay it off. And or if we lose money and we need if we lost money for the year and we don't have enough cash to cover our loss, the revolver will kick in for short-term debt to keep our company going. First thing we're going to do, we're going to find out cash. So I'm going to go to the last actual year of recorded year. And what I want to know is what is the ending balance of cash? So where do we go? We go to the balance sheet. That's going to be right here. This is going to be the ending balance of the year. And then this is called the corkscrew technique in finance. So I find the ending balance, and then up here is going to be the beginning balance of the next year. In our example, it's the beginning balance for the beginning of the projected year. So I'm going to go equals, go to the end, and that's just going to always bring up. So when we drag that across, you want the next projected year to bring in the ending cash balance. So we got the beginning, what we brought into cash. Then we want to know what is our cash, how did our cash change to see how much cash we have. To find out how cash changed for our company, we have to go to the cash flow statement. So I'm going to go all the way up to the cash flow statement. It's going to be on the bottom. Now, we have not done this yet. This is going to be when we do the financial statements after all the schedules are solved. I'm going to go to the change in the cash position. And then underneath that, I want to know, and it doesn't light up green because the cash position is not correct yet because our debt, our interest is not solved yet. Therefore, our income statement is not correct. It's going to affect everything. So that's why it's not lit up. So the next thing I want to do is find out the ending balance. The ending balance. Well, that's going to be the beginning balance plus the change in cash. So I'm going to hit all equals. We have all three of those solved. I'm going to go across, hit Control R, and now we have the cash part saved. There's two parts to cash. We want to know how much cash we have just in case we lose money that year. That's one of the reasons. The other reason is if I have a cash balance, I'm going to earn an interest on it. I'm going to put that into the bank and we're going to make some money. So first thing we want to do is find out what is the interest we earn per year. So I'm going to say equals. That's going to be in the assumptions page. And that's one of the assumptions in the case study. That's going to be the interest earned on cash. Wait, I'm going to bring that in. What I'm going to do is I'm not going to drag it across. I'm going to go to the next projected year, hit equals really quick, go to the previous year. Once you do that, I'm going to hold down shift. Now I can drag it. Make sure if you drag that from the beginning, it's going to be zeros because it's going to drag to the next cell. Double check your work, especially on the quiz or when you take the exam. Make sure you have all ones going across. Another technique is to go in here, hit Function F4, and I'm going to freeze it, and then I could drag it right away. I find it quicker is just to input it, go to the next year, hit equals, and do the previous. So every year you do will be the previous. Next, we want to find out what is our annual interest income. How much money did we make on interest? And this would be a positive amount. There's two ways of doing it. You could find the average of the beginning and the average of the beginning and the end. So you would put average of 0.3 plus that. You could do that, or you could just do the interest rate, and this is how I have it set up on the Excel sheet, and I'm going to multiply it just times the beginning. That is okay. So in the exam you take, you could do either one. You could do the average of the beginning and the ending, or just the beginning. I'm just going to do the beginning. Go across. So now we just solved cash. Two things we did. How much cash we have. We want to know from the beginning of the year to find out if we lost money. And the other thing is, did we make money on the cash? All right, next thing we want to know is, and this has to do with the revolver, are we going to use the revolver? Two things we have to do, find out how much cash we have, and then find out how much money we made for that year. So what we're going to do is, I'm going to find the operating cash flow. So we're going to find out what is our, right down here, our free cash flow for the year. Did we make money? Do we have to use a revolver, right? I'm going to add this total amount up plus the cash we brought in. So we're going to go straight up to the operating cash flow. Where is that? That's the cash flow statement. And that's going to be a total. Now it's not going to show it's going to be green, but that's going to be the operating cash flow. It's because our net income is incorrect because we don't have the interest solved from the debt schedule that goes into the income statement. Next, we want to know the investing. What is the investing cash flow? So I'm going to go up. Remember, financing, when I go up here, I'm going to show this real quick. Financing is the revolver, the debt we have, long-term, short-term debt, revolver, short-term debt. The other one is long-term. Are we issuing dividends? That's considered in financing. And then also, do we issue new stock, or are we purchasing back stock? But we're going to go to our investing. What is investing? That's the CapEx. So typically that's going to be negative. Make sure that if that is a negative, you have that in the negative in the debt schedule, because we want to find out how much cash we have. Operating is positive, investing is negative. Next, we want to know, what is our mandatory debt repayment? This is for the variable long-term debt. What is the mandatory debt repayment? Well, that's going to be in our assumption at the bottom here. That's our change in debt and equity. The mandatory is 25 million per year. That's what we estimated. So it's going to be a negative. We have to use cash to purchase the pay off that debt. So when the debt goes down, our cash, I'm sorry, if the debt goes, if the debt goes down, our cash goes down. If debt goes up, our cash goes up. So you want to keep that negative. Next is the same thing, which is fixed. So since I situated our assumptions that way, I could just go down. That's going to be correct. So what we're showing here is it's going to be a positive. We're going to issue new debt. That's positive. It's going to cost us, or I'm sorry, we're going to receive money. That's a positive. It's going to go into cash. I'm going to go down. That's going to be our preferred stock. We issued new preferred stock. So we sold preferred stock. Therefore, we got more cash. And then common stock, that was zero. We're not buying back or anything. So if we bought back common stock, that would be a negative. If we issued more, that would be a positive. So we got all that solved. Next is, did we pay, after all our operating or investing, after we paid off our debt, after we issued new stock, preferred stock, did we pay off dividends? So what we're going to do is I'm going to hit equals, and this is the only time we'll use the equity schedule. So you want to go below and find preferred dividend. So this is how it's situated, and we'll talk about it next video. We'll show the equity schedule. But I'm going to go to preferred dividend. This is the payout right here of the dividend if you own it. And the last is, what about common stock? Do we pay a dividend for common stock? So I'm going to go down here and I'm going to hit the common dividend. Don't worry about all that stuff. We'll do that next video. But I want to make sure we have common. Now that's not going to show correct right now. Why? To find out common stock, we had to input income. Common stock is only paid if you made money. Dividends is like a bond, always paid. So the common stock has net income. Net income is incorrect because our interest is incorrect. Right now, so far it is. So we got all that solved. I'm going to hit all equals. I'm going to sum those up. And now all I have to do, once you do that one column, I'm going to highlight those and we'll just drag that across. And then that should be correct once we have everything else inputted. All right, so now we know the free cash flow, how much money we have. We also know how much cash we have. Now we're going to figure out, are we going to use our revolver account? Well, the first thing we want to know, we're going to do the corkscrew technique again. The last actual recorded year that we have from the accounting department, I want to know what is the ending balance on a revolver account. Where's that found? That's a short-term liability. That's the bank debt revolver. It's only for short term. It means we paid off less than a year. I'm going to bring that in. And then above it, that's the ending of the previous year. Therefore, the ending must be the beginning of the projected year. All right, here's the hardest part. Now we want to do a function of, are we going to use our revolver? Okay, so I want you to really think about this is we're going to do a minimum function here. I want you to think about, why are we doing this? First off, I want to add up two variables. So let me explain through it. I'm going to add up the free cash flow plus the beginning value of cash. That's important, right? So I'm going to add those two up. And before I solve it, I'm going to hit comma. And then above it, I'm going to hit the revolver outstanding beginning balance, because according to the assumption, if we have money, we're going to automatically pay off the revolver. That's going to be automatic account. Okay. But if we are negative, that means I have to add more to the revolver because we lost money that year. It's going to automatically kick in, go into that account. So what are we doing here is, I'm adding up the cash we have and the free cash flow. So think about that. If those values are negative, if that's a negative value, those added up together, that means I'm taking the minimum, right? Now think further, that the revolver cannot be negative. The revolver is going to be zero or a positive amount. So if we have a negative free cash flow, it's always going to take that. If we don't have a negative cash flow, it will take the minimum between that and the revolver, which would automatically be the revolver. Okay. If it's zero, that's the minimum. That means we're adding nothing to the debt. If is positive, we'll automatically pay it off. Hopefully that makes sense there. And then in front, now I'm going to hit explain it. Why am I putting a negative in front of the minimum? Because I want you to think about it. If we have a negative cash value from free cash flow and the cash on hand, if that's negative, that will be the minimum. That'll be less than zero or a positive revolver. So that would kick in. I want to multiply that times a negative because that would be a positive amount. So if we're negative 25 million, well, I'm adding 25 million to the revolver. So that would be a positive amount. And if the revolver, which would show positive, if I'm repaying it off, let's say that was 5 million. So let's have a negative out there. This would take the minimum between the two and automatically pay off the revolver, which would make it a negative then, right? Because then what I want to do down here, I'm going to alt equals, I'm going to sum those up. So if we did have a balance there of 5 million, I'll take the minimum of the two. And if it was the revolver, because we made tons of money during the year, it would automatically pay it off. And that negative would flip it to a negative, and then it would make the revolver zero. If you have any questions, please email me. I can explain it further. See me in my office, or I'll see you in class. So we're done there. I'm going to highlight those 3 cells. I'm going to go across. This is the revolver. Next, I want to find out if we have a balance, how much interest am I paying on the revolver? Go to the assumptions page. I got the interest on the revolver. Again, I'm going to select it. I'm going to go to the next projected year, hit equals, hit the previous, and then go across, hit function, Control R to fill. Now we want to know how much did we pay? Well, we got the interest rate. So we're going to do the same thing. You could do the average of the beginning and the ending if you want to do. So you type in average of those two, multiply it times the interest, or, and I recommend this, do the beginning times the interest, just a lot quicker. That is acceptable as well. Okay, so we did cash. We found out, did we make money for the year? And then we'll find out about the revolver. And now we're going to look at our debt. Okay, so I gave you a couple reasons why the debt schedule is important. One of them are when we use the revolver, we want to know how much cash we have to make money. Also, I want to know balances. So keep that in mind. We just found out our balance of the revolver, which will go into what? The balance sheet. And now what I'm going to do is find out how much are we paying on variable senior secured debt or just variable long-term debt. And I want to find out the ending balance to put it into the balance sheet. So we're doing a couple things there. So we want to know the amount outstanding, the ending of the last actual year. So I want to get the variable senior debt. So I'm going to go straight up to the balance sheet. And remember, this is not going to be a current liability. This is going to be a long-term liability right below deferred income taxes. So we have variable senior debt, secured debt. I'm going to bring that in. And we'll do the same thing, corkscrew. The ending of the previous year will be the beginning of the next year. Now we want to know, what is the change in debt? Well, we already did it up here. I recommend, this is kind of a habit I've done, was just go back to the assumptions page so you don't accidentally bring something in. So I want to know, are we repayment of senior variable debt, or are we adding more? So we're going to repay it, pay it off, or we add more. So I'm going to hit the assumptions page. I'm going to go to that assumption. Well, we're going to repay 25 million a year. And then I'm going to hit all equals. I'm going to sum up the beginning to get and the change to find the ending. Scroll over, Control R. And now I want to find out the cost of our debt. Again, this is very repetitive, what we've done with the others. I'm going to do the interest rate. The interest rate, we have to find out, what are we paying on the variable debt? I kind of call it a little different there, but it's just look for the variable there. You can label anything you want. I'm going to put that in. Again, I'm going to hit equals, go across, Control. And then I'm going to go a little quicker because I think you know how to do it. Again, you can find the average of the beginning and the ending. I'm just going to multiply the interest rate times the beginning. That's acceptable. And without really talking about it too much, let's just do the fixed debt now. Go straight up to the balance sheet to get the balance. Corkscrew it in. Now I'm going to find the change in our fixed debt, which we're adding 5 million per year. A little different than we did before. I'm going to hit all equals, sum those up, highlight those, bring those across. You can see you can get pretty quick with this. And then we want to do the interest rate. I want to find out how much are we paying on fixed debt. And like you do before, you find the average of the beginning and the ending. I'm just going to do the beginning and multiply it times the interest rate. All right. So just want to show that when we have debt, it's a cost of interest, but we're going to display it as a positive number. Okay. We're not going to show as a negative. We're going to display it as a positive. So what we're going to do is I'm going to add up now our net interest expense is going to be the interest we're paying on fixed debt plus the interest we're paying on variable debt plus the interest we're paying on our revolver. This is important, right? We're showing a cost as a positive. We got cash, which is actual inflow of money. So what I'm going to do is, of all that money we have to owe, but I'm showing it as a positive, I'm going to subtract the income we got from cash, right? I'm subtracting it because we're making money off of that. And I'm going to go across, and there we got the debt schedule calculated. It's not totally solved because we have to plug some things with our application. So first thing I'm going to do, it looks pretty good so far. Let's scroll up. We're going to go straight to the balance sheet. We need to plug in the endings. This is important. You're going to plug in the ending balances of the revolver and the different debts that we have, the variable and this fixed. So I'm going to go down. This is going to be the ending. I'm going to find the revolver. So where is it at? Remember that, the ending balance. So I know this can get kind of complicated, but it makes sense if you think it through. I want to find the ending because the balance sheet is always the ending for that year. So I'm going to bring that in, go across. Now we want to find the ending of variable. Now they're together. Oh, never mind. I can't just drag down real quick. So we'll go to variable. I'm going to find the ending balance, right? Not the expense, but the ending balance. And then I'm going to go to the fixed debt ending balance. And where does that come from? It comes from our repayment. How is it changing? Well, the ending, we're going to add 5 million per year. So all I have to do is highlight those two. I recommend just doing those really quick before you drag across. Again, it's not all green, right? For our retained earnings, why? If you go up, our assets, our cash is not correct. Our cash is not correct because our cash flow has not been entering in yet. All right, so now we have to fill in the cash flow. We're actually doing in the debt schedule, the debt schedule is solving a lot of the financing activities plus the equity schedule. So financing comes from the debt schedule and the equity schedule. So we're going to plug in, this is the cash flow statement. This is the change of cash. So we're going to do the revolver. So this is important. The balance sheet is the ending balance. The revolver is not the ending for the cash flow statement. That's the balance sheet. We want to know the change of cash. So we're going to go all the way back down to the balance or the debt, and I'm going to select the change. It was that equation that we did, the negative minimum. That's what you want to bring into the cash flow statement. Next, we want to find out, what are we doing with the variable debt? Well, make it pretty easy here. I'm going to go to the assumptions. There's the variable debt. I'm going to hit enter. So that's just the change of. And then right underneath that is the fixed debt. Right underneath that. So it's pretty easy if you set it up right, which is the preferred stock. Are we buying more or are we repurchasing? Underneath that is the common. So very quick, you can get on the financing part, everything in our assumptions, if you aligned it with your cash flow statement, align those. So I highly recommend is when you create your assumption page, highlight the first four, 1, 2, 3, 4, 5, the first 5 lines right here in the finance activity and just paste it into the assumptions page. Have them lined up together so you can get that done quick. Underneath this, we need to know the dividends. What's the change in dividends? Well, that's in the equity schedule. That's underneath the debt schedule. We're doing preferred stock first. So you see, this is important. We have that as a positive value in the equity schedule. We have to pay that to shareholders who own preferred stock. Therefore, in the cash flow statement, that will be a negative because it costs us something. And then we want to find common dividends because we have to pay those out as well. We want to know dividends are always going to be positive. You never bring them in, right? So I'm going to go all the way to the common stock. And look, that's a positive value. I have to make that a negative. It's positive there, but it's really costing us something. So we got that. And then I'm going to sum up all those values. on the cash flow statement. I'm going to highlight all those, go across, Control R, and we are almost there. All right, now let's go a little further up. Notice our, so this isn't correct yet because remember common dividends? When I showed it from the beginning, I had net income to find out how much you're paying to dividends. It's a certain percent of net income we're paying to the dividend shareholders or the shareholders or dividends. Well, net income is incorrect. Why is net income correct? Incorrect is because our income statement is not correct yet because we don't have our interest expense inputted in. So I'm going to say equals. I'm going to go all the way down to the debt schedule. So what we're going to do is we're going to go all the way down to the net interest expense, right? When we solve this down here, that is the income statement. All right, hopefully it lights up green. So the income statement looks good, and it's always good to check this. You're good at it. The cash flow statement is nice and green. The balance sheet looks like it balanced. Yep, it balances. The debt, I got to figure out why this debt schedule is. See, I made that mistake. This is good. Is what I talked about earlier. Well, that's a negative, right? That's a negative. So I got to make sure I put a negative. That's one thing I forgot. Perfect way to make sure we teach that. That what we're looking at here for the revolver, I'm looking at is it positive or negative because I'm summing all those values up. And just remember, dividends is always a negative. And oh, and that should correct the problem I had. Let's see. Okay, we'll scan it over. So just keep that in mind, which I just made that mistake. Negative for that, negative for purchase back debt, mandatory debt repayments, positive if we're going to get new debt, it expands debt. Dividends are always negative, but the equity schedule does not show it as a negative. Go back up and then I'm gonna look at the grade. Hopefully it shows 100%, which it does. There you go. Any questions, please let me know. God bless, and I will see everyone in class.